buying an asset or something.
Yeah, that's what we are doing. That's why depreciation will come here. The total depreciation charge for the year will come.
What about the accumulated one?
The
accumulated,
there is no provision for depreciation here. So if there was provision for depreciation separately, then we'll prepare provision for depreciation account. Are you getting the idea? And prepare assets at cost. But this is assets at what? Net book value. So we prepare it like that.
Shall I write net book value? Right.
So we assume that the depreciation charge is the only depreciation we are considering here.
Yeah, because we had book values.
Okay.
Do you get the difference?
So that's the depreciation we add.
So what is the acquisition? The company we acquired, what is their assets? Check their format and give me their property, plant and equipment. 800. So acquisition from the start, 800. Then we need to ask ourselves the depreciation for the year. We credit it. So how much was the depreciation for the year? 1,800. Is there any other thing we need to deal with? Was there anything like revaluation of assets? No. So we balance it. When we balance, the difference will be seen as either an acquisition or a disposal. Right? So let's balance it up. Which side is bigger? What? Credit side is bigger?
Yes.
Of?
18,600.
18,600. So the balancing figure will be what? Additional acquisition. 2,200. So when we go to the investing activities, you will take that as the acquisition of what? Property, plants, and equipment.
Why are we adding the subsidiaries assets?
Why? What are we doing?
But I'm thinking that the assets, this was the asset when we are going to acquire them. Like this, the 800 is when we are going to acquire.
Yes.
Then at the end of the year, we're giving that the total thing is 16,800.
Do you know that technically, look at it, do you know that this figure plus this figure gave us this figure minus this figure plus this figure? You get the idea? So he was asking about the fact that this 800 is already included here. And I'm saying that this 800 technically is actually the opening balance plus the acquisition. This is what is at the end of the year. Into the year subtracting depreciation. Into the year subtracting into difference means that there is what? A further acquisition. Next is my favorite, income tax. Whatever. Your big head, whatever. Your big head, whatever. I knew that was what you were coming to say, right? Okay, how do we prepare tax? Can I have tax? Opening, closing. Tax keeps a credit balance. So balance brought forward, we go for it. 900. Balance carry forward. We pay tax how much?
600.
So in the income statement, 600. So we balance it off. The difference go where? For the year. So tax paid for the year. How much? 900, I guess. So 1,005, 1,005. That's all. Simple, sweet, to the point. Why are we adding the tax charge for the year? Because tax charge for the year is a provision which will increase our tax liabilities. So when we strike it out, when we look at the opening and the one that is charged for the year and subtract what was outstanding at the end of the year, then it means this is how much we actually paid. I'm saying that if we bring the opening tax balance and look at the charge of the year, it means when we subtract what is outstanding at the end of the year, that means the difference is how much we have paid. Right? So it is more or less like we paid what was at the beginning of the year. Next. Yes.
Is it possible that the president can still say that there were no disposal? But after doing the PP,
will be an error from the examiner's perspective to make such a conflicting statement. But in such situations, if you trust yourself that there was an acquisition, they had an asset, there was a depreciation, you brought the figure, and still the figure has to be on the credit side, go for it and do the right thing. And then that will be giving you the marks. So it could happen. ICA, they can make errors.
What if the examiner is silent on it, but there was an acquisition? There could be an acquisition.
But in this question, did he tell us they did an additional acquisition? He was silent. It's a balance in the betray whether there was acquisition or disposal. Let's go. The next thing is to prepare the share capital account. Please make sure you understand the treatment of this as well. Why are we interested in this guy? Because we want to find out whether we issued some shares during the year or we repurchased some shares during the year. But from the balance sheet we have there, our share capital is increasing. We want to find out, is it really increasing because of the share we issued to the subsidiary, or after we issued the share to the subsidiary, we did an additional issue? So let's go for it. Opening balance, please. 10,000. Go for it. Closing balance. 14,800. Then remember, we issued shares to the subsidiary. If it was a share exchange and Kaembaha, may emphasize on it because I know your mind will be doing that to you. So share issue. And that was from Workings 1. How much was it? 3,600. Any other item, we balance the account and see whether there was an additional acquisition or there was a repurchases of what? Shares. Which side is bigger?
Yeah.
So 14,800. 14,800. So if the balancing figure is here, what does that mean? Increase. So that is what? An additional issue of shares. What do we have? 4. And I don't punch out there. Should I punch out there and just rock? 120. Let's smack you with a man and you will be steady. Are you okay? Let me ask you this question. Did we get any money from the share we issued to the subsidiary? Did we get any money from the share we issued to the subsidiary? Did we get any money from the share we issued to the subsidiary? Come on now. I'm asking you this question because when we get to investing, should we bring this 3,800 and this 1,200 there? Sorry, when we get to financing, that's what I'm asking you. The share issued to the subsidiary, did we get cash from there? The question didn't say, but we didn't get any cash. It was part of the consideration. So the only thing that we will bring under financing activity will be what? The 1,200, which was what brought us some cash. Sounds good?
Yes, then it doesn't mean when there's a share exchange, we will treat it, but we will not send it to the cash flow because share exchange will not involve cash.
Right.
So
That's
we'll do
it.
the same way as this.
But you know, share exchange, our shares will not increase. So Mbahapo, that was what I just emphasized before writing.
So that one will not come at all.
It won't come at all. Because share exchange, you don't affect our number of shares.
You mean a book?
Yes. Share exchange means the share we already have, no? We are using it to exchange what we have acquired from you. So it's the same number of shares we have it. What did I say? Me were 10 cedis 5. Who are 5 cedis? 10. Me, that's a me pay 5 cities 10 now. What will I give you? Are you getting the idea? So at the end of the day, how much money I have, is it not the same thing? Will my money increase?
No, but the number of
But it depends, it also depends on the
Number
value
of
of the
shares.
The what?
the value of the share.
The value of the shares. As in,
per share.
Now maybe share
The
premium.
parents.
no!
If the value is not the same as what is being issued,
If the value is not,
like if the value of the share increase,
I'm listening.
like if I'm issuing and the value increase from what it was, like it will not, as we are saying, it will not add up. Maybe that will be like it will increase, but it will not be added up.
The only place share premium comes to town is when we are talking about issue of shares to be subscribed by either our shareholders or third parties. But if we are doing share exchange, there is no issue about share premium on it. Why? Because our stated capital is not changing. Once our stated capital is not changing, we don't care how much we sold to them, because that figure is actually put into calculation of consideration, which comes into goodwill, which goes into the balance sheet of them.
Yes, so I want to explain. So the share exchange, you always buy the
Okay.
So you are going to acquire the company.
Right.
So the company has maybe some number of shares.
Right.
So you are saying maybe you issue 1 share for every 2 shares in that company.
No, this is it. Last week, didn't I let you write that things down? I told you that when it comes to consideration transfer, there are 3 components of consideration transfer. 1, the cash you pay. 2, deferred payment, what you want to pay in the future. And then 3, share exchange. Share exchange is where you say that, all right, the company has 8,000 shares, and you are acquiring 90% of that. So give me 90% of 8,000. What do I have, please? 7,200. This is the share you have acquired.
Yes.
But the policy was that you agree with them that, hey, I don't have money, but I want you to still have ownership in your business. Because when I give you the money, you're going to be paying capital gain tax. And you don't want to pay capital gain tax, you rather prefer dividend. So you want continuous existence of control in the business. So I said that, okay, for this 7,200 that I've acquired, I'm going to give you 2 shares for every 10 share I acquired from you. So I acquired 7,200, but I'll give you 2 shares for every 10. So I'll divide this by 10 times what? 2. This is the share exchange. The share exchange is part of the financing of my acquisition of you. So the reason why share premium doesn't come to town, the reason why stated capital will not be considered is because you are not giving me money. It is the terms of our agreement for me to acquire and take control of it.
Okay, so now in the new business, if I had maybe 10 shares, now in the new business I will have only 2 shares. Let's
Right.
say I have 2 shares,
Yes.
10 shares in the whole business.
Yes.
So now I have 2.
Yes.
Okay.
Are you getting the idea? So, yeah, that parent company, stated capital still remains the same. Because it was part of financing.
Well,
Your father's name is what?
I'm serious. Okay, so that is our share capital. Then these are the 8 core workings, but there is 9th one that you're not going to always be doing it. I'm not supposed to do it, but I prefer to do all these workings. The held for sale investment. What is it about? Held for trading investment. Sorry. What is happening to it? So look at what we do. We bring the opening balance, how much?
1,008 or
Then the closing balance,
22 or and
the difference will be what? 400. Add or subtract. Sorry. Is it increasing or reducing? Increasing. So that is what? Again. Why did you do this? Why did we do this? We did this because if there is held for sale trading, then this 400 was added in deriving what? The profit, the total profit for the year. Are you getting it? So we need to go and subtract it in our cash flow statement under the operating activities. Then the 10th workings. I don't know. It's like I want to do 12 workings. 10. The 10 workings, I think it's not the workings though, but as I mentioned, I would want to do everything across. Long-term loan. So when I get to my cash book, I present a neat cash book, statement of cash flow with workings corresponding to each of them. So long-term loan, what is happening? What's happening? Opening.
6,100.
Closing.
6,500.
What's happening?
Increase.
Of?
More money coming
Hey, are you sure?
in. Hey, no.
It's the bobo.
18,000.
What's the opening?
18,000.
Is that the opening?
Yes.
What's the closing?
14.
What's happening?
Increasing.
Of
So I add 10.
4,000. What does that mean?
We are paying.
So repayment of loan. So what figures were you throwing at me like that?
NCI.
Hey, sorry. Look at the key one, 11. Look at this one. Look at this one. It is called movement in working capital.
So we get mark on this.
Yes, sir. Because you need this to go to your cash flow statement, right? So it will be marked.
If your cash flow doesn't balance, you just create an adjustment in the cash.
In the and see what? Suspense account. Profo. So let's have movement in working capital. Inventories, receivables, and what? Payables. Now follow me and look at how simple that is. When you come on there, come on there. And now you have that. Which one? What's the opening balance inventory, please? Feed me.
12,000.
Trade receivables,
8,200.
payables,
10,200.
now follow me. It's movement in working capital. But remember, during the year we acquired a business. So the business we acquired, the working capital, so what is the inventory for the business we acquired? 2,200. Receivables? 700. Payables?
500 negative.
What's it?
500 negative. It's negative. In brackets.
Oh, are you serious?
No, sorry.
It's payable, so we add.
That's correct.
Give me the balancing figure, please. Give me balancing figure.
14,200.
No, I've not reached it there yet. 14,200.
8,900.
8,900.
10,700.
10,700. So give me closing balance.
11,600.
11,600. 9,400.
8,700.
8,700. So let's get the balancing figure. That will tell us whether something is increasing or decreasing. What do we have?
2,600.
2,600. Mm-hmm.
500.
Mm-hmm.
2,000.
Now, tell me, is inventory increasing or reducing?
Shall we compare what to what?
Oh, look at the balancing figure we had. Is it increasing or reducing? Inventory is what?
Reducing.
Now, once inventory is reducing, when we go there, what do? We add, right? Meaning money is coming into the business. Receivables, what's happening to them? It's increasing. So what do? We subtract. Payables, what's happening to them? Decreasing. What does that mean? We paying them. So we subtract. That's the movement in the cash flows. Movement in working capital. So you can put it down. And the workings will follow like this now in the exam hall. Just like this now.
Aisha, can
Yes.
you show this one on the face of the what you are preparing?
On the balance, on the face of the cash flow. Yeah, you can show it. You can show it. Just that I don't know your spacing out. You see, to make sure that you are not really squeezing figures up, because that means you will bring the three elements here. And assuming it was a foreign transaction or foreign subsidiary, we would have brought forex loss or gain here. So it will mean more item would have to be written there. So you can bring it there, but maybe to squeeze. That's why I prefer to do that.
Yeah, finally,
Yeah.
finance cost.
Mm-hmm.
The additional information.
Yeah.
Finance cost is interest on loan. On any sign, any gain on the health of trading investment. All interest due was paid in the year.
Right. All interest due. Have we done any workings for that?
No.
Finance costs include loans and any gain on assets held on investment. Okay. So where's the finance cost?
Finance cost is
Is there as
it's 450.
it's 450 here. And we are told that this 450 actually includes two
Yeah.
things. Interest on loan and any gain on what? Trading. Right. So what is the gain on trading?
200 when we calculate it.
No. 400. Another one.
Yeah, 400.
400. That means the finance cost is what?
50. So that is what I was referring to. That when we're preparing the first one,
Yeah.
the payable,
Yeah.
then we have to bring the full.
When we are preparing the operating.
operating,
Mhm.
we have to bring the whole 450.
Okay.
However,
As a
when we-
subtraction.
as a subtraction,
But when we come down here,
the finance cost paid.
will be the 50. That is the difference.
But you see, it will be the same thing because we have to deduct the 400 then
From there.
from the top there.
Yes. So at the end of the day, it will be the same.
Yeah.
How we are getting it.
Hey, try. We're right. After that, you do that one. It's not fair.